Burns, I want to jump into some of the stocks that you got on your mind because right now it looks like this market is tempted to go under some kind of deep rotation. What do you think?
Well, yeah, we expect to see, we certainly could see a bit of a continuation of, you saw starting the beginning of September, a bit of a rotation back into value. It's been a really long 10 years for value equities relative to growth. And if you think, well, what has been the catalyst? Probably if there's been one catalyst that really has driven this movement from momentum to value, it's been that we've actually seen a little bit of a steepening in the yield curve. That's something that, was we've seen a little bit of a little bit of positive news on the trade front. Signs of progress potentially in Brexit, and that steepening of the yield curve probably would be bode fairly positively for value. And again, probably the biggest case for value equities at this point is really just reversion to the mean. I mean, it's been sort of a long walk in the winter for value investors over the last decade, and as a result of that, the valuation discrepancy between value stocks and growth stocks is about as stretched as it's been in a long time. Over the last decade, growth, the Russell Growth Index has outperformed the value index by over 300 basis points per year. I mean, value cycles and growth cycles tend to be long, but not this long. That's even longer than what we saw during the dot-com bubble. And so reversion to the mean does probably bode favorably at some point in time for value equities.
So Burns, you look at sectors like industrials and healthcare that have been performing throughout this couple-month period of value outperformance. I know there's sectors that you like as well. Do you need to see continuing bond selling or yield curve steepening for it to sustain, or are we maybe at an inflection point where, look, when we look at some of the charts for these growth names, when they break, it's just kind of they break. I mean, we know speculative names can have this kind of momentum shift.
Well, it's actually a little bit, it's an interesting case. It's almost a contrarian case to make for some of these cyclicals, such as the industrials, because if we all concede that, this has been a long expansionary cycle, and if we're somewhat late in the cycle, then why would we be going into cyclical names? But we do believe it's possible for the markets, because equities have gotten a little bit rich, for the markets to be range bound, but for there to be a rotation within. And some of these cyclical areas, such as the industrial sector, are trading at least a standard deviation below their long-term average relative to the market. And so, if investors are worried about a recession, that those might get hit. But in many ways, a lot of those names are probably already gone a pretty long way towards pricing in the next recession.
Let's talk about a few of them. Do you like Humana among them on your list of holdings? When we see the response after United Health earnings as well, looks like this group might be finally getting a little reprieve from the politically induced pressure it's been under.
Well, that's certainly a contrarian play. We think of ourselves as contrarians. I always say if you look at those names and everyone's nodding their heads knowingly, then I know maybe we've gotten away from our contrarian leanings. And that's the health insurance and managed care companies are some of the ones that have been the worst hit this year. In many ways, there's almost a negative correlation between the way they've traded and the way Bernie Sanders and Elizabeth Warren's prospects for the election have gone. And there's certainly a bit of, you might even call it an existential threat when we think about what Medicare for All could do for private health insurance. But for investors with a longer term time horizon, and likewise with a leaning towards being contrarians, these are some names for which we feel the upside downside risk is favorable. In the case of a Humana, you've got a company that typically trades at a pretty steep premium to the healthcare index. Right now, it's at a discount. They've doubled their earnings over the last 5 years, and this is a name that if the overall goal is reducing healthcare costs, then they're probably more likely to be part of the solution than the problem, because of the fact that they're a pure player in Medicare Advantage plans. These are plans whereby the government outsources the managed of Medicare to private insurers, and this is an area where that's where they get about 3/4 of their revenues. And the number of patients on Medicare is growing about 3% per year, so they have that secular tailwind. And the percentage of those going into Medicare Advantage plans has also been rising. And so they have a few tailwinds such that if you are going to go into the managed care and health insurance space, that they offer a little bit of a safer way of doing that for, again, investors that they're probably going to have a political target and there's going to be a lot of concern for the next year and a half. But if you look out 2 to 3 years, then we think that the valuation actually bodes favorable for them.
Okay, let's talk energy here as well, because when we think about the cohort of stocks that would be contrarian if there is this kind of reflationary trade, yield widening, you'd think energy might be one of them, but it's like crude oil can't hold a bid to save its life burns. So for a stock like EOG, which you like, tell me the thesis on that.
This is a name for which, if one is going to go into the energy space, then right now the place to go is higher quality names, companies that have lower costs, and EOG is really one of the best of the best. We as value investors typically can't afford EOG because it normally trades at a pretty steep premium. But right now, investors can get EOG at a PE multiple trading in the mid to low teens. You have a dividend yield of 1.5%. That's pretty good for the E&P space. And this is a company that, when you think of horizontal drilling and unconventional drilling, they practically invented it. They have the best management, the best technology, the best acreage. But at the same time, they've also proven themselves to be much more shareholder friendly than a lot of the wildcatter drillers out there, such that they've raised the dividend by double-digit rates per year for this entire millennium. And they're not just growing for the sake of growth. They've also grown cash flow by, I think, 12% per year over the past decade. And so it's one of the premier players. They have lower costs of oil production, and they're just a lot more shareholder friendly than you can find anywhere else in the space.